Hi, I'm Jimmy. In this video, we're going to look at inflation, the possibility of inflation moving higher, and what investments could do well if inflation does in fact begin to move higher. And then hopefully we can use this information to improve our investment portfolio and ideally get us closer to our goal of achieving financial freedom. Okay, so let's jump right in. So first, let's start with what inflation is. And interestingly, there's actually some debate about the best ways to define inflation. So personally, the way that I've personally defined inflation is as the average change in the price of goods and services. I took that from the way the Federal Reserve defines inflation, and frankly, sort of the way I learned about it in school. But when I've talked about inflation in the past, in previous videos, well, many people have said that inflation is not the measure of prices going up or down, but rather a measure in the change of the money supply. And technically, sure, I can agree with that. Both definitions usually work since they're really intertwined with some from a cause and effect perspective. So, as the money supply increases, well, in theory, each individual dollar would have less purchasing power. The more dollars there are, the less purchasing power each individual one would have. As purchasing power goes down, well, prices tend to go up. And just like that, we have inflation. But personally, I actually think it makes more sense to look at the change in the prices of goods and services as our measure of inflation. And here's just a quick example of why. So back in the financial crisis, well, this blue line here represents what the M2 money supply looked like. And as we could see, well, the US government really started to ramp up the amount of money supply that they push into the economy as quantitative easing and things along those lines were happening. So they essentially injected more capital into the system. But when we add the CPI, which is the Consumer Price Index, this measures the changes in prices in goods and services. Well, we can see that during this very same time period, this spike up, well, inflation had begun to go lower. And we can see that inflation even turned into deflation when it dropped below zero. Deflation is negative inflation, essentially. So I think that this is actually a good example of illustrating the relationship between the money supply and an increase in the supply, an increase or decline in the price of goods and services. And this is why I personally avoid saying that an increase in the money supply is inflation. Yes, there is inflation in money supply as money supply is going higher, but an increase in prices of goods and services and an increase in money supply is not exactly the same thing. Now, the reason that I said that, yes, the two are tightly woven together is look at what happened right here. There was a decent jump in inflation. Yet, during that very same time period, right above it, well, the money supply didn't go much of anywhere. And frankly, that's because the government can manipulate the money supply far faster than they can push through changes in the prices of goods and services. It takes time for that to filter through the rest of the economy. So this increase in the inflation rate was almost certainly tied to the previously the rapid increase in the money supply. So they don't happen at the exact same time, but they are very much tied together. Now, of course, we're simplifying this a bit. The money supply isn't the only factor to take into consideration. There are many examples. I've had different examples pointed out to me, something like Venezuela, which has printed excess money, and because of that, their inflation rate is through the roof. Or you can look at a country like Japan for a while that they were struggling with deflation. They were struggling to have any growth, and they continued to increase their money supply. So it's not as simple as that. Oftentimes, interest rates are tied to this whole thing and many other factors within the economy. But that's a simple way of looking at inflation in general. Now, if we expand this chart a bit and look at the M2 money supply this is from the year 2000 to just recently, well, we can see that this little bump here, well, this is the analysis we just did during the financial crisis, where they ramped up the amount of money that they were essentially printing. And yes, that bump up looks rather puny compared to what has happened since then. Because, as we can see with this most recent jump, well, the money supply in 2020 really went through the roof thanks to the coronavirus and the massive injections that the government has done. And there's no real sign of this slowing down. There's a lot of expectations that this will continue to happen, at least in the near future. Now, when we add inflation to this chart, well, we can see that we already looked at the deflation that came about during the financial crisis, and we haven't really seen that in this past year. But this huge jump in the money supply is very likely to cause at least some increase in inflation beyond the current expected level. Now, we're not really sure of how much inflation, but most economists agree that more inflation is coming. Plus, on top of this in general, which implies inflation should come, well, the Federal Reserve has come out and said that they're going to allow inflation to tick higher with some of the rule changes that they've had. So our question is, assuming that inflation does come, at least an increase in inflation beyond what we currently have, well, what types of investments are likely to do better if inflation does ramp up? The one potential investment that many people know about is real estate. Real estate tends to do better in higher inflationary economies. Now, for us stock investors, one way to possibly get into real estate without having to go out and buy actual buildings is to invest in something like a real estate investment trust, or REIT for short. And basically what we could do is we could jump in and buy a REIT that then invests in, let's say, apartment buildings. Well, higher inflation could cause apartments or could cause rents to increase, therefore making the REIT more money. And it could, in theory, increase the value of that property in general. Once again, helping that REIT. Now, REITs also get some tax advantages. They don't have to pay corporate income tax if they pay out a lot of their profit as dividends. Therefore, real estate investment trusts tend to have very high dividends. So if people like dividend investments, REIT is something that could do well in a higher inflationary environment. Another beneficiary of higher inflation are a lot of growth stocks. Growth stocks tend to do well. So first thing that jumps to mind is technology stocks. They tend to do well in higher inflationary environments. And I'm sure we could all think of some examples that could do well there. Similar to that, well, not really similar, but another one that does well is something like energy. Energy tends to do well. Now, energy prices have already started going up. Perhaps that's the early signs of more inflation, but energy stocks tend to do fairly well when inflation is a bit higher. Now, those stocks are a bit high right now, so I'd like to see them pull back a bit, but again, there's good possibilities over there. Now, another component of this to consider is with higher inflation, well, it might make sense to avoid something like bonds right now. So I think anything that has fixed income tied to it. So if we would go out and buy a bond for, let's say, 5%, that bond is paying us 5% on an annual basis. If it's a long-term bond, let's say 10 years, and inflation ticks up for any extended period of time, well, that could end up being a problem because a lot of the value we received if we bought it today is going to get chipped away at. So I think it makes more sense to focus on stocks. Now, many bonds are important to a portfolio and they offer good diversification benefits. So if we have to go into bonds, well, there are bonds that increase their payments or increase their value based on inflation. Those are called Treasury Inflation Protected Securities, or TIPS for short. So if we're concerned about inflation but still want to be involved in bonds, perhaps TIPS could make some sense. But besides that, for me, on a personal basis, I prefer to stick with stocks. Since stocks in general, not any one asset class, but oftentimes stocks in general, the stock market in general, does well with higher inflation. So for me, I think that it makes more sense to focus on that. Now, if we like dividend stocks, well, I recently did a video where I go through 7 of the most popular dividend stocks. And in that, there's actually a couple stocks that sure they pay a dividend, but they're very low dividend amounts. They're really more growth stocks. So those stocks could really be a double whammy. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.